Imagine you are, you're seeking shelter from a massive stock market storm. Things are getting volatile, the red arrows are flashing everywhere, and you just run into the sturdiest building you know.
Right, you want safety.
Exactly. And for decades, that building has basically been the companies that make your daily soap, your noodles, your toothpaste, fast-moving consumer goods or FMCG. It feels incredibly secure because frankly, people still need to wash their clothes and eat, whether the broader Nifty index is sitting at 22,000 or 26,000.
Oh, absolutely.
But what if once you're inside that fortress, you look down and realize the foundation is like actively crumbling?
Well, that is the exact reality a lot of investors are waking up to right now in April 2026.
Yeah.
The market is aggressively questioning the price of that safety. I mean, if we look at the Nifty FMCG index just since the start of the year, it's already down roughly 12 to 14%.
12 to 14%. Wow.
Yeah, that is a serious correction for a sector that is supposed to be your bulletproof vest,
Yeah, which means we can't just blindly hide in these household brands anymore. So today, we are doing a deep dive into an incredibly timely piece of source material. It's an analytical report from the Equity Decoded newsletter, and it's titled India's FMCG Sector in Q4 FY26.
Yeah, and our mission with today's deep dive is really to equip you with the mental models and the stark financial realities to look right past the brand halo of India's biggest household names.
Especially right before earnings season kicks off. Okay, let's unpack this because the macro environment the source describes right now it's just a total contradiction.
It really is a tug of war. The sector is currently being pulled apart by two incredibly powerful opposing macroeconomic forces. Let's start with the upside, actually, because the demand side of the equation is finally showing a pulse.
Right.
Rural demand in India is not only waking up, but it is officially growing faster than urban demand right now.
Right. Wait, really? That feels like a massive reversal. Because for the past couple of years, the story has consistently been that, urban premium consumers were spending while the rural heartland was basically holding on to every single rupee. What actually flipped the switch?
Yeah, it's a great question. Several specific catalysts just collided at the perfect time to put discretionary cash back into the pockets of rural consumers. You have the PM Kienso direct government cash transfers hitting bank accounts.
Oh, right, direct cash.
Exactly. You combine that with a genuinely solid Rabi harvest, which obviously boosts agricultural incomes.
Yeah.
Then you layer on falling food inflation and the income tax relief announced back in budget 2025.
So they actually have money to spend again.
When you add all of those elements together, rural consumers actually have breathing room. And this is critical because these massive FMCG companies, they rely on rural India for roughly 35 to 45% of their total sales volume.
That is a huge chunk.
It is. So because of this structural revival, the overall sector is projecting revenue growth of about 6 to 8% this financial year.
6 to 8% sounds phenomenal, honestly. But we have to look at the other side of that tug of war. The cost to actually make and package all those products is getting wildly expensive, isn't it?
Oh, the raw material squeeze is severe. Over just the last month, Brent crude oil has spiked over 34%.
34% in a month.
Yeah, heavily driven by the ongoing crises in West Asia. But it's not just the oil that fuels the supply chain trucks. Crude palm oil, which is a foundational ingredient in nearly everything, from your daily soap to your packaged snacks, that's up over 14%. And then you have polypropylene.
Let me guess, that's the plastic packaging.
Spot on. It's the plastic polymer used to wrap almost every single FMCG product sitting on a supermarket shelf. The cost of that specific material is up nearly 25%.
It makes me think of, running a diner. Imagine you own this neighborhood restaurant, and after a brutally slow year, you suddenly look out and see a line of customers wrapping around the block.
Right, that's your rural demand waking up.
Exactly. You're absolutely thrilled. But then you walk back into your kitchen and realize the wholesale cost of your meat, your vegetables, and even the plastic takeout containers you use to serve the food, they've all just skyrocketed overnight.
Yep.
You are pushing more plates out the door, but your actual profit on every single meal is getting squeezed to death.
The tension in your kitchen analogy is the defining story of Q4 FY26. If you simply rewrite your menu to pass those higher costs onto the customer, that line out the door might just vanish.
Because they can't afford it.
Exactly. Consumers are still incredibly price sensitive because their income recovery is fragile. So as these companies step up to report their earnings, top-line revenue growth is going to be nothing more than a vanity metric.
Right, because selling more volume doesn't matter if it costs you a fortune to make it. Since the background picture is this muddy, the source insists we need an unforgiving filter before we even consider touching an FMCG stock today.
Yes, a very strict filter.
They laid out a 5-point investor checklist. Let's walk through the mechanics of it. Point 1 is demanding consistent sales growth over a 5 to 10-year horizon. Not just a temporary bump, but like real demand.
Right, you are looking for organic, compounding demand for the product itself. Like, did sales go up because more human beings actually wanted to buy the shampoo? Or did sales go up simply because the company hiked the price by 10%?
Or because they acquired a smaller rival.
Precisely. You want proof of a growing customer base.
Mm-hmm.
Point 2 ties directly into your restaurant analogy. You need stable operating profit margins, even when input costs are wildly fluctuating.
The source frequently uses the term EBITDA margins here. We should probably clarify that for anyone who doesn't spend their days staring at balance sheets.
Yeah, good call. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Basically, it is a company's core operating profit before the accountants get involved with complex tax write-offs and debt structuring.
Got it.
If a company's EBITDA margins collapse, the second palm oil gets expensive, their brand moat is an illusion. A true moat means they can absorb some cost shocks without bleeding out.
Point 3 shifts from margins to outright efficiency. The checklist demands high and consistent return on equity, usually anything above 20%, and return on capital employed above 25%, sustained over multiple years. How should a listener conceptualize those metrics?
Think of it as a measure of how effectively the business uses the cash it already has to generate even more cash.
Right.
If you give this company 100 rupees, how many rupees does it yield purely from its own operations? Consumer goods companies shouldn't require massive, multi-billion-dollar factory overhauls every single year just to maintain their business. There should be highly efficient cash printing machines.
Which naturally leads to point 4 on the checklist, almost zero debt. I mean, if they are an efficient cash printing machine, they shouldn't need to borrow heavily to keep the lights on or to fund their growth.
Exactly. Heavy debt in a consumer goods business is a glaring red flag.
And finally, point 5. The valuation has to match realistic growth expectations, not flawless execution. Now, I have to push back here.
Well, go ahead.
Isn't there a very old, very popular golden rule in investing that if a company is a beloved household brand, something you physically interact with every single morning, you just pay whatever the market asks to own a piece of it, you buy quality, and you hold it forever?
What's fascinating here is how often that exact sentiment leads to catastrophic returns over a 5 to 10-year period.
Really?
Oh, absolutely.
Yeah.
Let's translate paying whatever the market asks into the actual math we are seeing today. Some of these beloved FMCG brands are currently trading at a price-to-earnings, or PE ratio, of 70 to 74x. When you pay 74 times a company's annual earnings for a share of their stock, you are no longer just paying a slight premium for a high-quality business.
You're paying for a fantasy.
You are making a highly leveraged bet on a decade of absolute perfection. A 74x multiple assumes that for the next 10 years, they will never have a bad quarter, a competitor will never steal their market share, and their growth will never slow down even a fraction.
And given the surging oil and plastic prices we just outlined, perfection is practically impossible.
Exactly. A phenomenal business can be a horrific investment if the price you pay leaves absolutely zero room for real-world error.
So with that unforgiving checklist in hand, let's actually grade the heavyweights. We have to start with the company the source calls the barometer for the entire sector, Hindustan Unilever, or HUL. They are set to report their earnings on April 28th.
Yes, a very important date.
The thesis is pretty clear. If HUL's margins hold up, the entire sector breathes a sigh of relief. If they stumble, everyone else goes down with them. Why do they hold that much psychological power over the market?
They are the ultimate test case, purely due to their scale and their penetration into the Indian household. The consensus right now expects HUL's revenue to be roughly flat compared to the previous quarter.
Okay.
But the singular metric everyone on Dalal Street is watching is their guided EBITDA margins, which sit in that 22 to 23% range.
Delivering that kind of margin requires incredible operational gymnastics right now, given the polymer and palm oil costs.
It does. Their volume growth in Q4 of last year was a rather sluggish 2%. The assumption is that the rural recovery should naturally push that volume higher this quarter, but protecting that 23% margin while pushing volume is the only test that matters.
And how do they stack up against the checklist?
When you run them through it, they look relatively resilient. They have near zero debt, an unparalleled distribution network, and they are trading at a 34 to 46x PE ratio.
Which makes them the most reasonably valued of the big players. Although calling a 46x multiple reasonable feels a bit absurd. It really just highlights how insanely expensive the rest of the sector is right now.
Yeah, that's exactly the point.
So HUL is the barometer. But the source highlights Nestle India, who actually sets the tone by reporting first on April 21st as the ultimate quality trap.
Nestle is a fascinating case study in the difference between a business and a stock. Their fundamental operational quality is basically bulletproof.
Because they aren't dealing with the same imported inflation.
Right. Unlike companies struggling with that, Nestle is actively benefiting right now from easing domestic wheat and sugar prices. Furthermore, they are almost entirely insulated from the geopolitical disruptions in West Asia because their revenue is overwhelmingly domestic.
So they easily earn an A grade on the checklist for sales growth, debt levels, and return on equity.
Operationally, yes, but the stock earns a C. They are the prime example of that massive 70 to 74x PE ratio we discussed earlier.
It reminds me of booking a luxury vacation. Imagine you find this gorgeous five-star resort, but to stay there, you have to pay for 10 years' worth of vacations entirely upfront at peak premium pricing.
Oh, that's a great analogy.
The resort itself is undeniably beautiful. But because you paid such an astronomical premium, if it rains for even one single afternoon over the next 10 years, you are going to feel totally ripped off. That is what buying Nestle at 74x earnings feels like. The premium you paid demands absolute sunshine every single day.
Which is why we are seeing something incredibly rare in the financial community right now. Widespread consensus. Most major brokerages are honestly listing the stock as a hold.
That rarely happens.
Almost never. No one is doubting the brand legacy of Maggi or Nescafe, but the valuation downside risk is just too steep. The margin of safety is practically non-existent.
Nestle really proves that staying safely within India's borders is great for protecting your margins right now. But what happens to the brands that got ambitious? The ones that wanted to be global players? Did that geographic diversification protect them, or did it just expose them to new dangers? Let's look at Godrej Consumer Products and Dabur.
Yeah, let's start with Godrej or GCPL. Domestically, they are performing brilliantly. They are currently the volume growth leader, guiding for double-digit sales growth within India.
That's strong.
Very strong. They have built an incredibly durable domestic moat in specific categories like household insecticides and hair color. And they're successfully holding their margins through smart efficiency measures.
But the source points out a major thorn in their side, their international portfolio. They have severe commodity issues and something the report calls foreign exchange headwinds in their emerging market operations. How do FX headwinds actually damage a company that is, selling more products?
Think about the mechanics of international sales. Say Godrej is selling millions of units of hair color in an emerging market like Nigeria. They are making a solid profit in the local currency, the Naira.
Okay, makes sense.
But Godrej is an Indian company. Eventually, they have to report their consolidated earnings in Indian rupees. If the local currency heavily depreciates against the rupee, which is exactly what has been happening, when they convert those local profits back to India, a massive chunk of that money just vanishes into thin air.
Wow.
It gets entirely eaten by the exchange rate.
That explains why their PE ratio has such a wildly uncertain range, anywhere from 55 to 79x. The market legitimately does not know what their baseline normalized earnings actually look like because that international currency performance is such a volatile swing factor.
Yeah, it's a huge unknown.
And if Godrej's international adventure is causing headaches, Dabur's global footprint is completely dividing the analyst community. Nuvama is telling clients to buy the stock, while Morgan Stanley is explicitly calling it underweight. They report on May 7th, 2026. What exactly is causing such a stark analytical divide?
It is a profound tale of two geographies. Within India, Dabur has an incredibly defensible moat built around its Ayurvedic positioning. They are consistently delivering solid, high single-digit growth domestically.
Right.
But the anchor dragging down their entire balance sheet is their massive historical exposure to the Man-Air region, the Middle East to North Africa.
Wait, I always associate Dabur with their deeply Indian Ayurvedic heritage. Why are they so heavily exposed to the Middle East?
Well, if we connect this to the bigger picture, it highlights a profound shift in corporate strategy that hasn't aged well. Back in 2018 and 2019, aggressive geographic diversification into the Manor region looked like a brilliant risk-mitigating expansion for Dabur.
They were tapping into a new market.
Exactly. They acquired local personal care brands to capture a booming demographic. Fast forward to 2026, and that exact same diversification has mutated into highly concentrated geopolitical risk.
So the exact same West Asia conflict that is driving up the wholesale cost of crude oil, which hurts their manufacturing costs everywhere, is also severely disrupting the supply chains and consumer demand in their MENA markets. They are getting hit with higher costs and lower international sales simultaneously. Because of that double whammy, their consolidated overall growth is dragging along in the mid-single digits.
The analysts disagreeing on Dabur is actually the most intellectually honest signal in the entire FMCG sector right now. The domestic business is reliable, but that international geopolitical risk is a massive, unresolved variable that makes valuing the company incredibly difficult.
So international exposure can obviously muddy the waters, but the source points out another trap that has nothing to do with geography and everything to do with how the math itself can trick you. Let's look at Marico and this concept of base effect arithmetic.
Oh, Marico is the perfect study in why you can never just read the headline of an earnings report. They recently guided the market to expect double-digit operating profit growth for this quarter.
Which, to a casual investor, sounds like a massive structural turnaround.
It does, but you have to dig into the denominator, like what are they comparing that growth against? They are comparing it to Q4 of FY25, which was an absolute disaster for them.
Right, their margins collapsed by 2.6% a year ago.
Exactly, because the prices of copra and coconut oil, which are essentially the lifeblood of their product line, were at record highs.
I see.
Precisely. If you only made 10 rupees last year because of a crisis, and you make 11 rupees this year, technically you just achieved 10% growth. But if your historical normal is making 20 rupees, you aren't actually growing. You're just bouncing back from an artificially low baseline.
That is the base effect. Bouncing back from a disaster is not the same thing as unlocking new organic demand.
Right. And yet, the stock is still trading at roughly a 55x PE ratio.
So the vital question for anyone looking at Marico is, are you paying a premium multiple for an impenetrable brand moat, or are you just paying a premium for a mechanical cyclical recovery in commodity prices that might already be peaking?
We won't know the answer to that until we see their Q1 FY27 guidance. They need to prove they can grow past their historical baseline, not just recover to it.
That distinction leads perfectly into the three psychological behavioral traps the source warns about, the pitfalls that catch even incredibly smart, seasoned investors. Trap number one is the price hike game. We talked earlier about companies trying to pass costs onto consumers, but the mechanics of how it actually happens in FMCG are fascinating.
It is entirely about market structure. When HUL decides they have to raise the price of a bar of soap to protect their margins, Dabur and Marico almost immediately follow suit.
But why doesn't the consumer just switch to a cheaper alternative?
Because in an oligopoly, the cheaper alternative vanishes. It is not an illegal backroom cartel, it is just self-preservation. If HUL takes the risk of angering consumers to protect their profit, and the smaller competitors don't match that price hike, those smaller players are choosing to swallow the cost inflation themselves, which destroys their own margins.
So they all move in step.
Yes, they all move together. Pricing power in this sector isn't always proof that a brand is irresistibly loved. Sometimes, it is just a byproduct of a few massive players controlling the entire board.
Wow. Trap number two is the halo effect. We already covered this with the Nestle example. It is the dangerous psychological habit of confusing a genuinely stellar product with the assumption that the stock deserves to trade at an ever-rising valuation forever.
Right. People fall in love with the brand.
You pay a 74x premium on the way up. Their quarterly growth slows down by a fraction of a percent. The market brutally corrects the multiple, and you are left holding the bag on a great company and a terrible investment.
And trap number three is perhaps the most deceptive one facing the market today.
Yeah.
The rural recovery risk. The data proves the rural recovery is real. The tractors are selling. The PM Kisan money is flowing.
But the investor's job is not simply to figure out if the news is good. Your job is to ask, is the good news already priced in?
Exactly. That is the golden question.
If you are buying these household names at 55 to 74x valuations, the rural bounce is already completely baked into the stock price. If the earnings report comes out and they simply meet expectations, the stock isn't going to suddenly soar because the market already paid for that growth 6 months ago.
They paid for perfection.
So what does this all mean for you? If you are looking at your own portfolio right now, how do you navigate the next few weeks? Let's consolidate this pre-results view for April 2026.
According to the Equity Decoded Framework, HUL and Marico are the most sensible names to monitor closely. HUL because of its relative value and its position as the sector's anchor, and Marico specifically to see if their future guidance confirms a genuine structural turnaround rather than just a mathematical base effect illusion.
And what about the others?
Conversely, Dabur carries incredibly high execution risk due to its geopolitical exposure, and Nestle carries massive valuation downside risk.
The practical advice from the source is crystal clear. If you already hold these stocks, do not get distracted by top-line sales growth. Watch the profit margins like a hawk. If you want to buy, sit on your hands and wait until after the earnings are officially reported. The risk-reward ratio right now is simply not in your favor. And if you are evaluating the sector fresh, start strictly with the financial checklist we discussed, not the familiar brand logo sitting in your pantry.
It is the oldest lesson in the market. Great brands make excellent products. They do not automatically make excellent investments at every price.
That is the ultimate takeaway for earnings season. But before we wrap up today's deep dive, there is one final provocative thought I want to leave you with. Something to mull over that builds on everything we've discussed today about the nature of these businesses.
Yeah, we spent a lot of time today talking about the legendary FMCG moat, the idea that these companies are completely protected by their decades-old legacy distribution networks and their oligopoly power to raise prices in unison.
Right.
But consider the technological landscape rapidly shifting underneath our feet. What happens to these 70x valuations when AI-driven direct-to-consumer algorithms eventually figure out how to bypass those traditional distribution choke points entirely?
Oh, that's a wild thought.
If a smarter, fundamentally cheaper, highly targeted distribution model breaks their unwritten pricing cartel, will the ultimate safe haven disappear forever?
A profound question worth holding on to as you watch the numbers roll in this week.